This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the American Monetary Association's podcast, where we explore how monetary policy impacts the real lives of real people and the action steps necessary to preserve wealth and enhance one's lifestyle.
Hey, it's my pleasure to welcome Matthew Sullivan. He is founder and CEO of Quantm Real Estate, and he's coming to us today from my old hometown, Newport Beach, California. Matthew, welcome. How are you?
Very well, Jason. Thanks for having me on.
So there's a lot of talk about blockchain and cryptocurrencies, and, it's just all over the news the past few years, of course. The ups and the downs, tokenizing everything, blockchain revolutionizing the world. Tell us what you do at Quantm Real Estate and what it means to people listening.
I think the most important group who would be affected by what we're doing are homeowners who have equity in their homes.
And when you say that, that could be investors or owner-occupants, right?
Absolutely. So if we look at single-family residences, those residences that are either owned as investment properties or are owner-occupied properties, the biggest problem that we solve is if you're an owner of a home, whether it's your own or an investment property, and you have equity that you've built up in your home, the only way that you can access that right now is to go back to the bank and to borrow more money. And when we embarked on...
Or you can, of course, sell the property.
Well, exactly, right. which means there's no
Don't forget
yours.
that. It's minor detail, but yeah, okay.
So the objective here is, how do you unlock what is effectively dead money without going back to the bank, without increasing your borrowings? So what we do is we buy a percentage of the future value of your home. So that means that we're effectively buying a percentage of the equity in your home. And we're doing that without taking on more debt. So that allows you to free up capital in your home without monthly payments, without interest, and you've got up to 30 years to either sell the property or refinance that contract.
Okay, so someone comes to you, they say, I want to extract the equity from a property I own, and you give them cash for the equity, right?
Yes.
But you take an ownership share, right? Rather than putting debt on the property. Is that correct?
The way it works is actually simple. It's more simple than actually taking an ownership share. What it doesn't involve is changing who is on title. And that's a very important point to get across. So you don't sell us ownership in the property at that point. You sell us the right to future appreciation in your home. So effectively, as a homeowner, you're allowing us to buy an option from you, which is a personal contract, so that when you sell your home, the price of the contract is the value that you want to release.
Do you record that option? Do you record some kind of lien?
Absolutely. So it's recorded as a lien. It's a junior lien. It says junior to the current debt on the property, and it's recorded as a performance deed of trust. So we're on title, and when we go through the escrow process, that protects the investment. But as a homeowner, what happens is that you get access to that capital, and it works as an option scheme, which means that we don't have to go back and change who's on title at that point. It doesn't trigger any taxes.
What is usually we speak in terms of LTV, loan to value ratio.
Yeah.
What is the, token to value ratio, the option to value ratio?
The important thing is not to, although there is a cryptocurrency sort of tokenized element to what we do, as far as the homeowner is concerned, there's no exposure. They don't have to understand that. So the relationship between us and the homeowner is expressed in US dollars. So we don't have any...
I got it. But on the back end, you're using cryptocurrency or tokens or the blockchain.
We're using a tokenization, but if we sort of park that for 1 second.
We don't need to go there yet, right? So you give them money. Just tell us, because the people listening like to follow my refi till you die plan, right?
Yes.
Which means extract equity from your properties, use it to buy more properties. It's a good deal. There's no question about that. It's a good deal. But the question is, how much can they extract? Okay, so let's just take an example. For round numbers, they've got a $100,000 single-family home. They currently have a $50,000 loan against it. Yeah. How much can they pull out?
Well, we use loan to value. So we use the term combined loan to value. So
Right.
we're looking at if we combine the equity that we release and your current debt, it must not exceed 90% of the current value of the home, which is the appraised value. And the other factor is we will advance a maximum of 30% of the current value of the home. So in your situation where you've got a $100,000 home, $50,000 worth of debt, if we were to advance our maximum, which is $30,000, that would be within the $90,000 cap. So we would be able
so the maximum loan is $30,000 no matter what, right?
30% is 30%
Of the value. Okay.
Of the value,
so it's either
yes.
30% of the value or 90% combined LTV. Is that correct?
That's correct. So those are the upper limits. So it's anywhere between those limits.
So 90% of the LTV for cash out is pretty aggressive. It's good for the owner if they want to pull a lot of cash out, but that seems like you might not be protected enough if things go down, right? Or no?
Remember, we will only advance 30% of the value of the home. So that 90% takes into account any existing debt. So if you have no debt on the property, we will only advance you 30%. So the 90% figure takes into account any existing mortgages. So our maximum exposure, if there's a debt-free property, is 30%. But you're right, if we go up to 90%, that leaves us with a 10% cushion. But we're also very careful about underwriting those types of properties where we're getting very close. Historically, and our team has completed over 300 of these transactions over the last 9 years. Historically, we tend to work with people who have a much higher equity position in their homes. They tend to be people who have paid down a fairly large amount of equity and are looking at ways of getting some of the, the value of that, but are absolutely very resistant to going back into debt.
Okay, so they get a fairly high LTV. That's good, and they don't have to make any payments on it.
That's correct, absolutely. And that's
so
the
so
biggest
they in that way it sort of mimics a reverse mortgage. Would you say that?
It's similar to a reverse mortgage, because in a reverse mortgage and with an equity release product, the common thread is that there's no monthly payments. So from the surface, they appear very similar, but they're two very different products. With our transaction, it's a once-off transaction. It's done based on the value of the home at that particular time. What happens with a reverse mortgage is that the interest payments, the nature of the name reverse mortgage is that your payments come out of the equity. So the longer you have the mortgage, the less equity that you have. And if you take out a reverse mortgage and your house begins, if you go into a downturn, for example, then it tends to eat into the equity at a fairly accelerated rate. So what happens is that a reverse mortgage is a debt product. Even though you don't have the monthly payments, they're all rolled up and it all comes out of the value of your home.
But yours is in essence an equity product. I mean, even though you don't record an ownership share, you do an option. And I have a feeling you do that because of the securities laws, I'm guessing.
As far as the homeowner is concerned, it's not a security.
Well, that's my point. I'm saying you do it because it's not a security, I'm guessing.
We do it for our security. In other words, we need to record it on title because when the home is sold and goes through escrow process, we need to make sure that out of the sales proceeds.
I get it. That's not what I'm talking about. I know you need security. That's why you record your option. It's called a performance trust deed, right?
Performance deed trust, exactly.
Yeah, and that's what California calls it, by the way. And you're only doing this in California currently, right?
Currently, absolutely.
But you have plans to roll across the country.
Absolutely right.
Okay, great. So in different states, it'll have a slightly different name. Performance mortgage maybe will be the name in other states. I'm not sure.
Yes.
But when I say security, I don't mean security that you'll get repaid, collateral style security. I mean security like the SEC would view it. That's what I mean, right? Because if you were to fractionalize ownership or something like that, things become a lot more complicated than recording that option, right?
Yes, they do. But see, what we're doing is we're creating, so the pathway is you create the real estate asset by having the agreement with the homeowner. So when the homeowner agrees to exchange a percentage of the future value of their home for cash, that option creates a real estate asset because it's the right to receive a potential future value or the increase in value of the home. So we take that asset and we put that asset into a REIT and we create instruments, or we create ownership instruments, effectively shares in the REIT. That's where the blockchain and the tokenization comes in. So the securities element is really to do with the REIT and the way that we sell ownership interests in the REIT. And that's the way that we raise the capital that enables us to deploy that capital with the homeowner.
That's what you do on the back end. I'm really just focusing on what the investor gets out of the deal, or the homeowner or investor, either one. Could be owner occupied or not, right?
Yes. The homeowner, whether, again, owner occupied or whether or not it's a rental property, they get a single payment from us, and they have an undertaking to sell their home or refinance our transaction within 30 years. There are other undertakings that they make to maintain the property, to pay taxes, because effectively we're silent partners in that asset. So they have to make sure that they maintain the property so that we don't have any risk associated with, a decrease in value of our asset.
So I'm wondering why, and, explain this as quickly and as simply as you can. Why do you do it the way you do it on the back end? I mean, you create a REIT and then a token and all that. That seems a little overcomplicated, or there must be some reason or big benefit for that.
A REIT is the standard way that one would create capital, because we have to find sources of capital to be able to invest in these real estate assets. So in order to
Sure, but you can do a lot of things. You can sell loans on the secondary market. You can just put loans in a pool. They don't have to be a REIT. They don't have to be tokenized. Really, the question is, where does the tokenization come in? Why is that important?
One of the biggest problems that you find investing in this particular asset class, which is a $15 trillion asset class.
Right, and guess what? Almost none of it is tokenized.
And none of it is tapped. So in other words, other than us, and we have a couple of relatively small competitors in the grand scheme of things, there is no way of getting access or being able to participate in equity in single family homes. You can participate in debt. You can lend money, you can be a hard money lender, but actually being an equity participant. So for a start, it's a large, untapped, and a relatively high-performing asset class. Now, the tokenization element comes in for liquidity. Now, we create a REIT, which is a standard real estate structure.
Yeah.
Capital goes into the REIT. We deploy that capital.
And REIT means Real Estate Investment Trust, REIT. Go ahead.
Absolutely. The real question then is, how do we raise money into the REIT? Now, we can issue shares like a normal private placement.
Like all the REITs do, sure.
One of the biggest challenges is, if someone's an investor in the REIT, how do they get out? How do they liquidate their holdings? How do they capture the profit? Right. As the value of the pool of assets increases over time, the value of those membership or ownership interests will also increase. And the question then is, if you are an owner in a traditional private placement, it's very difficult for you to sell your interest. It's time consuming, it's expensive, there's no secondary market. Right. What tokenization does is create the ability for us to offer a secondary market.
Right, but it's your token, right? Or is it Bitcoin or Ethereum?
No, it's our token. So
it's your own token. So
yes.
It depends on your token having a secondary market, right?
Correct. The difference is, and that's absolutely right, but the difference is that we have an instrument that now can be traded on a number of security token exchanges.
Okay. So what is your token called?
EQRE. It stands for Equity Quantm Real Estate, okay. EQRE.
Great. You've already issued the token, I guess?
Well, we're beginning to issue the token now. So as capital comes into the fund, we issue new tokens.
Okay. On the consumer side, have you done any of these loans or options, or had anybody free up their equity yet? Have you done that yet?
We have experience on our team of over 300 transactions and almost $250 million
Right,
worth.
But those are traditional mortgages, I'm guessing.
No,
right?
no. Those are all the same types of deals. Those are all the same equity release transactions. So the team that we brought in were pretty much the founding fathers or the inventors of this type of asset class. So we managed to entice them to join us. So we've just started as Quantm Our platform went live in December last year. So we're now at the very beginning of raising capital into our fund so that we can deploy it. But we have almost 1,000 inquiries from people in California who want to release equity in their homes.
Right. Oh, you'll have no problem getting people that want to get equity out. I don't think that'll be any trouble at all. I think the harder part will be, selling the token and, doing all the stuff you're doing on the back end. Maybe I'm wrong about that, but, feel free to speak to that.
The reason that we're doing this is to make the investment more attractive than if we were to use a traditional method like a private placement. Okay. So we're using private placement regulations, Regulation D, and we have a Regulation A+ application in with the SEC. Mm-hmm. And the benefit is, if we fast forward, let's say 3 or 4 months to when the Regulation A+ offering is qualified, that means that anyone that buys our token will be able to sell that token immediately if they want to. Right. So what we're doing is we're creating what is effectively a private placement, but with secondary market liquidity. And that has been the biggest issue, I think, with real estate, private placements, crowdfunding, anything that is non-publicly traded. One of the biggest issues if you're a private holder is how do you sell your interest? How do you sell your holding?
Yeah, I get it. They're trapped in the investment. The one thing I didn't ask you on the consumer side for the borrower, if you will, I don't even know if you call them a borrower because it's sort of different. What is the effective interest rate that they're paying on this equity release? I don't want to call it financing, but I guess it's financing. It's just
they're selling an interest. So it's finance is very much debt terminology. So what you're talking about is education. So one of the biggest challenges we have is educating people that this isn't debt. It's a once-off transaction. We don't come back and knock on their door and say, you owe us X amount of interest on monthly payments. The effective interest rate really depends on the performance of the property. So if the property goes up in value significantly, it'll be one figure. If the property is flat or if it goes down, we run the risk as a co-investor in the home of potentially losing money. Mm-hmm. So it's very much a partnership. So the effective interest rate is really determined by the performance of the home and how long the person holds the contract for. But the critical difference is that this product is available to people that either can't afford to take on more debt or simply don't want to.
Sure. It's very appealing there because you're not qualifying the quote-unquote borrower, I guess. You're just qualifying the property, I'm guessing, right? We're
doing both, but in the reverse order. Normally, if you're taking out debt, what you're looking at is the person's ability to take on that additional loan.
Sure.
In our situation, we're underwriting the property and we're saying, well, what do we think the potential future appreciation of this property is? Right. And then we look at the person and say, if there's debt on the property, do we think that they're likely to be able to maintain that payment? Mm-hmm. So it's really a maintenance thing from a debt perspective, but it means that we could be much more flexible, when we talk about FICO scores.
Absolutely. The area where it seems like they could get burned is if they want to refinance you out later and get a traditional mortgage, what becomes the price? You got to establish what the equity is worth, what the option is worth. But you didn't answer the question about the interest rate either. I mean, how do you value the cost? I mean, is it just you say, okay, for 30% of the equity, we take a 30% ownership stake and whatever it's worth then? Is that how it works?
No, to answer that, there's a very straightforward multiple. Whatever the percentage of the value of the property that you release, we take 2.5 times that as a percentage of the increase in value. So let's say you have $1 million home and you release $100,000. That's 10% of the value of the home. Mm-hmm. If your house goes up to $1.1 million after 5 years, for example, we would take 2.5 times that initial 10%. So that's 25%. We take 25% of the increase in value. So the increase in value is $100,000. So we get our initial $100,000 back and we get $25,000, which is that percentage of the increase in value. And that's the return on our investment.
So the interest rate is effectively, I mean, I know it's not an interest rate. I completely get that. But if you calculate it in terms of a cost of funds or an interest rate, it would be 25%?
It would be 25% over that 5-year period.
Divided by 5.
So that would be, in rough figures, equivalent to around, 5% a year.
Right, but the complexity comes when you don't know when there's going to be a liquidity event. Maybe they're going to sell it in 5 years. Maybe they're going to refinance it in 5 years. Maybe they're going to hold it for 30 years. how do you do those demarcation points along the way?
So you're talking now about the fund. In other words, how does the fund make money? So from a homeowner's perspective, you're happy because it's a once-off transaction. You don't have to revisit it. You've taken some chips off the table. If your property goes up, that's fine. I'll share it with you. If it goes down, fantastic. I've managed to make some money. So the homeowner's always going to be happy. As far as the fund's perspective, it's about taking a long-term view. We know that the average homeowner duration is 7 years.
And that's increasing, by the way. I'm sure you know that.
Yes, but the important thing is that the assets that people are buying, and this is where the liquidity is so critical, the token that you're buying can be bought and sold in secondary markets. Now, that token represents ownership of the fund, and we revalue the assets in the fund every 3 months. So we look at all of the properties that we have. We look at the value of the assets that we brought them in at. So when we originate a transaction, we value the property by using an appraisal. And then when the property goes into the fund, every 3 months, we use third-party valuation methods from companies like CoreLogic, House Canary, Zillow, and our own third-party appraisals. And we revalue those properties by looking at the increase or decrease over that 3-month period.
That's where you can really get into some disagreements. You know, I'm talking about from the owner perspective, the owner is obviously going to be at odds with the fund potentially in the future, right? If they want to liquidate, and then there's an argument about, well, no, there's not going to be an argument about what it's worth if you just put it on the open market, because that'll be the appraisal. That'll be okay. But if they want to refinance and buy you out, then
that's done on an appraisal basis. So we always use third-party appraisals on that basis. And you're right, but that's the same with any real estate transaction, because valuation is always something that's relatively
Well, not
subjective.
with a lender. You know the amount of the loan and you know the amortization schedule, so you know that.
Yeah, but if we're using third-party appraisals, and the homeowner has to trust the third-party appraisals, and there's certainly every opportunity for them to bring in their own appraisal company if that's a company that we're happy to work with. So finding the valuation of a home is relatively easy, right, compared to a commercial project, for example, where there are so many more moving parts.
Yeah.
And the great thing about this asset class is it is a very straightforward asset class to understand in terms of pricing. So, we work with the homeowner as far as possible, to make sure that there are no gotchas. We give them 30 years. Some of our competitors who offer similar products restrict that to 10 years, for example. Mm-hmm. So that's, so we're giving them 30 years. We also charge a lot less than our competitors. We charge 2.5 times rather than 4 times, for example. Mm-hmm. So it's a very competitive product. And also, if you are comparing it to a debt product like a HELOC or a second mortgage, it's important to understand that if you're in a position to take out that HELOC, then by all means go ahead and take it out. But if you're not in a position to do that, then we're offering a really viable opportunity. And also, if you simply don't want to add debt, to take on more debt, and you feel that you've got the equity, in many cases it's a smarter option because you haven't got that debt overhang.
Yeah. Okay. Yeah. Very, very good. Wrap it up. Give out your website and any closing thoughts.
Yeah, well, the website's Quantm Re, which is QUANTM re.com. The site is really there for homeowners. If you're a homeowner looking to release equity, we're working to put together our waiting list for California. So feel free to go and give us your details and we'll let you know as soon as we have capital available. If you're an investor, you can invest. If you're an accredited investor, you can invest online and you can invest in the fund, and we will issue you with tokens that after the initial 12-month period will then be tradable on secondary markets. So that's the plan.
Matthew, thanks for joining us.
Jason, it's a pleasure. Thanks for having me on.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.